their first crore. So what one your first crore gives you, it's a very important milestone. It gives you financial breathing room and reduces a lot of stress, freedom to take calculated career risks. Obviously, you cannot leave your job at 1 crore, but definitely it gives you some leeway, some freedom to take calculated risks. It provides you with the ability to provide security for your family, and it's a foundation to build generational wealth. As we'll see that your first crore is actually the hardest to reach, and every subsequent crore becomes easier and easier uh, after you reach that milestone of first crore. So what we learn in this specific is webinar is the saving versus investing decision. A lot of time is spent on where exactly to spend your time on, whether it's trying to learn investing or trying to increase your income, which will cover in the income problem. Next comes your replacing human capital with financial capital. Then we'll discuss the roadmap to your first crore. And obviously, we're going to discuss this bonus tip of mistakes to avoid, which I have personally made all of these mistakes in the initial part of my investing career, and obviously they'll be in the end Q&A session. But we'll be happy to take questions in the middle also. So Ankit, please keep a track of these questions, and whichever relevant questions come up, we can take up after every few slides. Okay, so let's get started. So this specific webinar, it's actually meant for younger investors, primarily in 20 to early 30s, who are early in their careers, who are earning their first significant income, and who are actually ready, seriously ready to build systematic wealth for themselves and for their family. Yeah. So I'll start with this specific quote of saving is for the poor and investing for the rich. And uh, for those who understand this, they understand. But for those who don't understand this specific quote, I think it's pretty evident. And over the next few slides, I'm going to explain what it exactly means. So let's say a person is currently having a portfolio of 2 lakhs, which is fairly pretty far away from 1 crore, and the expected returns are, let's assume for this example, the expected returns are 10%. So annually, what you will be making from this portfolio of 2 lakhs is about 20,000 a year. You increase it by another 2-3%, it will become maybe 2.5 lakhs or thereabouts, right? And at this stage, let's assume that you are saving a monthly 15,000 rupees. So this translates to about 1.8 lakhs per year. So as you see, your yearly savings are almost 9x of your overall returns that your portfolio is going to generate for the year, right? So I think this is pretty evident as to where your focus should be, where your most of your time should be spent. It is on those savings, right? Those savings, uh, initially when you are starting out, your portfolio is much more smaller, whereas your savings relatively are much bigger. And that's where your focus should be, that how do you increase those specific savings that you can invest in the markets. This chart gives you very beautifully, it shows you how every year, let's say you are saving $10,000 or rupees, whatever that number is, but every year in this example, it's given $10,000. You save $10,000 across those, say, about 40 years or so. In the initial parts of the your investing journey till about, let's say, year 15 or so, your savings that you do on a yearly basis are much more than your investment returns. So the returns that you generate from your portfolio are going to be smaller than what you're saving in the initial about 10 to 15 years. And only after that, your investments dominate. So, and towards the end, towards when you are closer to retirement, your investment returns are going to be multiple times of what you are able to save. So if you are still saving that $10,000 every year towards the end, your portfolio is going to be so big, it's going to be multiple times, at least in this example, it's 6 times, almost 6 times of what you will actually be putting to saving that specific year. So from this specific example in this chart, it becomes quite clear that the initial initial years of your investing journey, of your career as well, should be spent much more on trying to increase the income or the savings rather than trying to increase the returns. For most investors, they are mostly concerned about how do I increase the portfolio returns? Which specific fund should I choose? Should I invest in gold, silver, or mid cap, large caps? Or how do you identify multi-bagger stocks? All of these questions are important, but they're not really, even if you are able to figure the answers to these questions, it's not going to really matter a lot in the initial parts, really. So, initial parts should be definitely spent on trying to uh, trying to increase your overall uh, overall savings and income. Now, at what stage you should just switch over from focusing on investments and savings to focusing on income and savings to investments? There's a very simple formula for that. You calculate whatever you are saving on an annual basis, right? You calculate what your portfolio is likely to generate over the year, right? And if your savings are greater than your investment growth, focus on increasing your income and savings. And at the point where your investment growth, the returns from your investment portfolio becomes greater than your savings, that is the time you start focusing on optimizing your investments. That's the time you start spending more time on managing your investments. So that is, I think, the crossover point that all of you should keep in mind. The time of money, really, I am surprised by the kind of time that many people in the initial parts of their career, they focus on investments rather than on their career, right? So in this specific example that we have shown, expected annual savings, if it is about 2 lakhs, so at this specific point of 2 lakhs, you should switch from savings to investments. But prior to that, it should purely be on your income. How do you maximize your income, right? And how do you maximize your savings? And it's pretty widespread out there, the conventional wisdom, which many financial advisors focus on frugality. That cut your expenses where you can cut your expenses. I think for most people, there are definitely few people who are spending a lot more on their wants, and for them definitely this is the um right advice. But for most of the people, I think when you start earning, your income is pretty low, and you are unable to spend too much on your wants. Most of your income, about 80-90%, or even many cases it's about 100% of your income, goes towards your consumption needs, right? So you actually are unable to spend any money on luxuries also, right? So in the initial parts of the career, it is definitely, it's very hard to spend monies on those luxuries that you can actually cut down and save much more. You are unable to, even if you focus on this advice of focusing on frugality, you are unable to, you'll be unable to save much more. So the right advice is, or the right mindset is, you should be thinking about how do I increase my income, because that's how you'll be able to increase your savings as well. That is what you should be thinking much more on. You pick up a side project, a freelancing project, you pursue further education, or you try and climb the corporate ladder. You aim for promotions, bigger mandates, or leadership roles, right? So that's where most of your time should go, rather than on trying to focus on your investments. Really, if you just develop a systematic plan and put it on auto mode, you'll do just fine in the initial 5-10 years. You're really not required to spend too much of time on investments, right? So this specific chart also gives you very good clarity on why you should not be spending too much time on your managing your financial capitals. Initially, as you can see, the later part of the curve, which is slightly blue in color, it starts from almost zero. This is the financial capital. So when you start earning, your financial capital is close to zero. You build it across the years, and at the time of retirement, it's close to highest. This keeps on rising even after retirement, but after a point it also starts reducing. So round about your retirement or so, this specific financial capital is the highest, but the highlight here is that the initial parts of the your career, it's closer to zero. Whereas your human capital, what is human capital? It's the present value of your future income, right? So if you are say 25 years of age, you'll be working till 60. So you have 35 years of earnings in front of you, right? So for those 35 years, whatever you'll be earning and you discount it to the present value, that specific number is your human capital. And your human capital is the highest in the beginning, right? So these are the two types of capital out there, human capital and financial capital. And again, which gives you the maximum leverage, which gives you the maximum returns. In terms of, you see where your absolute numbers are, your human capital is much, much more than the financial capital. So it's very, very clear from this chart also that in the initial years, maybe initial 10 years or so, you just focus on increasing your human capital. Now, we have also made a simple Excel, which I'll quickly share. This specific Excel helps you
Vivek,
determine what your,
we are seeing the PPT only. If you could maybe switch
yeah,
tabs.
I'm just trying to share. One second, give me a moment. Yeah, let me know if you can share, see the Excel file.
It's visible now.
Yeah. So this is a simple Excel file we have created to determine what your human capital is. So let's say you are earning in the initial, at this stage, you are earning 9 lakhs per year. The expected annual growth rate of your salary is, let's say, 10, and your remaining work years are, I'll put it as 30, right? The inflation rate is 6%. So your overall human capital at this stage is about 5 crores, right? Now let's play with these numbers a bit and let's see towards retirement. Let's say you are earning, say, 50 lakhs per year, right? You're still expected to grow at 10%, but the remaining working years are 5, right? So in this case, your human capital actually has come down, right? So this is the way, this is one tool that we'll be sharing towards the end. You can use to calculate your human capital. In fact, this is a very nice way of calculating your insurance needs also. Right. So they are essentially your life insurance needs can be calculated two ways. One is uh, you calculate your human capital, which is the present value of all the future earnings, right? And if God forbid you are not there, you should be your family should be able to replace your overall income, and this is the way to calculate. This is one way of calculating the life insurance need. Another way is when you determine what all expenses or financial goals are and the amount of money that you will require to achieve those financial goals. That is a second way of calculating your life insurance needs. So you can use it, definitely use it for determining your life insurance needs, right? So let's move ahead now. As it's very clearly explained here in the first part, your human capital is much more important, and that's where you should focus on. Okay. Okay. So now let's move on to the roadmap to your first crore, right? So the first question that comes to everyone's mind is how much should one save in order to achieve your first crore? Now there are many formulas that are available out there on internet. One is 50, 30, 20, that you invest 50, you spend 50% on your needs, 30% on your wants, and 20% on investing, right? And there are other on the extreme end. One says that you should actually invest 50% of your income in stocks and bonds in your portfolio. right? So there are many ways you can do this, but there's no one size fits all in finance. And this I'm really speaking from my experience as well, because everyone has different needs, goals, and you yourself are going to have different needs or goals at different life stages, right? So a fixed rule really does not fit everyone's situation. Yeah. And your ideal saving rate depends on your income stability, your life stage, and your financial responsibilities. So the best advice here is save what you can. Save maybe after spending on your needs. You do spend some amount of money on your wants, eating out, going out, vacations, all of that. Some limited amount of money on that, and whatever you can save after that, save it. Because as we earlier touched upon, that in the initial part of the year, initial part of your career, even saving 20% could mean a lot. It could really stretch your finances a lot, even that 20%. And from my personal experience, I know over different life stages, initially when I was not married, I was staying with four of my friends in a flat. So all most of the expenses were being divided by between four of us. And when I got married, obviously, we took up a flat along with my wife, and then at that time your expenses suddenly increases, right? After you have kids, your expenses keep on increasing, right? But at this stage, most of my needs are met, most of my wants are also met. So whatever I'm able to save much bigger part of my salary. And it could be different. Some people might have some support from their parents, from their family, whereas others might not have any support, or rather they have some financial obligations towards their family. So saving is really dependent on your personal set of life stage, your financial responsibilities. So the best advice here is save whatever you can, right? So the saving formula is quite simple. Saving is income minus spending. Your spending is needs, your wants, eating out, entertainment, and whatever is left is your saving. So for most of the people, as I said earlier, spending can be controlled, but you really uh, can't really outdo it. The best advice here is, or the best approach here is, focus on income. How you can increase your income either by taking freelancing projects, or reskilling yourself, investing on reskilling or upskilling yourself, taking up some courses, either going for an MBA. All of those things help you increase your income. Yeah. Yeah. Ankit, are there any questions that you feel we should take at this stage?
Um, I think not related to savings. I can't see any questions related to
Okay,
savings
let's
or
move ahead
income.
and we'll take a few after a few of these slides.
Sure.
Okay, so this is a chart that we have created, which tells you how long it's going to reach your first crore in how many years, dependent on how much you're saving. So we have assumed here from 20,000 to 50,000. So let's say if you are able to save 20,000 per month, and here the assumption is that every year your savings increases by 10%. The amount you are investing is increasing by 10%, and the portfolio is growing at 12% annualized returns. So in that case, if you are saving 20,000 rupees in 12 years, you will be able to reach your first crore. If this money is, let's say, 40,000, it's 8.7. Whereas if this money is 50,000, in about 7.7 years, you'll be able to reach your first crore, right? But note what's important here, or what's interesting here. So this is the uh, amount of time it will take for you to reach the next crore, right? So your first crore, in this specific case, we have taken saving of 25,000 rupees per month. Again, same 10% annual step up, which means every year you are increasing your savings by about 10%, and your portfolio is growing by 12%. In this case, you're going to reach your first crore in 10.8 years, roughly 11 years or so. But you'll reach second crore in 14.6 years. So about maybe about 3.5 years more, and you will reach your second crore. And your third crore, you'll reach in maybe 2.5 years. And look at this, from your fourth crore to fifth crore, it doesn't even take even 1.5 years, right? So your first crore, you are taking almost 11 years, whereas your fifth crore, you are able to reach at a much faster pace of 1.5 years. I'm sure from fifth to sixth, it will be closer to 1 year. And every subsequent year, you'll be able to make more than a crore every year, right? So this is starting with 25,000. Some of you might be able to save much more than this, whereas some of you might be able to save lesser than this, which is all fine. Save whatever you can, but the amount of time, the amount of patience, the amount of discipline it requires to reach your first crore, every subsequent crore becomes really easy and easy um, in future, right? One problem that I really want to talk about is managing your lifestyle, right? So as your income grows, your spending obviously tends to grow proportionally, or in many cases faster. This is many times known as lifestyle creep. So what's the solution for this, right? Or this is also known as lifestyle inflation, where initially you are driving, let's say, a car worth 6 lakh rupees, but after 5 years, you're not happy with that car and you now want to drive a car worth 15 lakh rupees. You are no more happy with a car which is worth only 5 lakh rupees. Or the house where you're staying in a 2 BHK. Initially, when you got it, you're very happy. You purchase your first house. 5 years down the line, you want a house, much bigger house in a much better society, let's say. So that is again lifestyle creep or lifestyle inflation. The best solution to this is whenever you get a raise, uh, you save or invest 50% of that raise immediately, and the rest 50% you can enjoy guilt free, right? So this is one example. Let's say your current salary is 6 lakhs and you are able to save about 10,000 per month from that. So your savings rate is, so your monthly salary is 50,000 and 10,000 you're saving. Say, so 20% is your saving rate, right? Next year you get a 2 lakh per annum raise. Either it's a raise or you switch jobs and your salary from 6 lakh become 8 lakhs. Now, this is 16,600 is the monthly increase. So the new savings, 50% of this increase goes to your saving and 50% goes to your spending. So in that case, your new savings become 10,000, which you were initially saving, and 8,300, it is 18,000, right? So your new savings rate is now not 20%, it has increased to 27.5%. And you obviously have, earlier you were spending 40,000, now additional you have 8,000 almost to spend more, right? So this is a pretty balanced view, but it's very good in the sense that uh, you'll be able to reach your goals at a much faster pace. I actually keep talking. In fact, just a couple of days back, I was talking to an investor who actually grew his income 5 times in last 5 years. He switched couple of jobs. He took some courses on the side, but he was in tech and he was able to grow his income 5x in last 5 years. But while talking to him, he didn't seem happy because he's not feeling any more financially secure as he was feeling 5 years back, just because his expenses have grown at a similar pace. So his savings, the amount of savings, the amount of money he is investing every year after 5 years, it essentially has remained almost same. There has been some increase, but it has been almost same for last 5 years, and that's why he's not feeling any financial security at all. Obviously, he loves to spend a lot. He loves going on vacation, spending money on gadgets and all of that thing. He loves that thing. But at the end of the day, he's really, really concerned about the financial security, right? So that's what happens. Your money, your income might keep increasing. You might think that if I keep increasing my income, I'm in a much better financial situation. But for most, it's not the case, because if your income, if your expenses are increasing at the same pace, it's not really helping you out. So as shown in this specific example, whatever your savings rate is, it could be 5% or it could be 50% that you are starting with. But your financial security is only going to increase if your savings rate is increasing. So it should not stay where it is. Every year, as your income keeps increasing, your savings rate should also keep increasing. I think this is one of the most important things in your part to reach first crore, because it becomes really hard. Even though your income might increase, if your expenses are increasing, it's becoming harder and harder for you to reach that first crore. And another thing is also that whatever you want to save, let's say for retirement, right? So your retirement amount of portfolio that you need for retirement is generally quite easy to calculate. It's if you have heard of that 4% rule, 4% retirement rule. So what that says is you can withdraw 4% in the first year of your retirement. You can withdraw 4% of whatever portfolio you have. So let's say for this example, uh, your expenses are 10 lakhs per year, right? So what you need is 25 times of that. That comes with 10 lakhs divided by 4%. So that is 25 times. So 2.5 crore is what you will need. If your salary increases, let's say in few years it doubles to 20 lakhs per year, in that case, your requirement for that retirement corpus has also gone up from 2.5 crore to 5 crore, right? So overall, you are not in a very good situation if your savings rate are not increasing. So that is one thing that you should really focus on after improving your increasing your income. You should definitely focus on increasing your savings rate, right? Why this works, this specific approach of 50% going to savings and 50% going to expenses is you don't feel deprived. It's not that your lifestyle is improving. You are spending some money definitely on your lifestyle needs also. Your savings rate, which is the most important thing, increases over time. You stay on track for your long-term goals, and there's no guilt about treating yourself, because I'm sure a lot of people think and plan for FIRE, which is financial independence, retire early, but then you have a lot of guilt about not being able to spend on few of the wants, few of these things that you want. So I think it's a pretty good balanced approach. You save 50% of your increased income and you spend 50% of your increased income, and your savings rate keeps going up. Right. Next is the power of asset allocation. Now, studies have shown that over 70% of portfolios returns. Yeah, Ankit, any questions by the way till now?
We have received several questions around income and investing as well.
Okay,
Uh, First question is from Farhan. He was able to increase his salary 12x in the last 6 years. So kudos to him.
great. Yeah.
But he's asking how do we track savings? Because in our assumption we have just taken 12% constant rate, but market doesn't behave in that manner. It fluctuates widely. So should we just track the SIP amount, the invested amount, or are we supposed to track the current value?
Current value of the portfolio?
Yeah.
Yeah. I think, see, control what you can control. So your portfolio value is not, is a lot of it is also dependent on the returns that market gives. So like for last 1 year, market hasn't given any returns. Uh, so market, when I say market, it's equity market. So if you've invested everything in equity markets, you might be down 5, 10, 15%, right? It depends a lot on your portfolio and the returns they are generating. So I don't think you should focus excessively on how large your portfolio is. What is in your control is the asset allocation is in your control. And also the second thing is how much you are able to save. These are the two things you should focus on. Yeah, those are the two things that you should focus more on. How much you can save. Again, in a very balanced approach. I personally like a balanced approach. That's what we have been talking about. Uh, एक एंड पे होते हैं कि people who are targeting fire in 10 years or even earlier, and they are unable, they don't want to spend anything at all, right? Whereas on the other end, there are people who just doesn't don't want to save and want to spend as much as possible, like getting a lot of credit cards, taking on credit card debt also. I like that balanced approach. So save whatever you can, focus on your savings what you can. Uh, Personally, for me, I found it very challenging in my time when I was doing this. uh, I heard a lot about track what you are spending. Now, I don't spend a lot really. I don't like spending on things. I definitely like spending on going out, going for vacations, traveling. So in my case, what happened was that I used to track all my expenses, right? Obviously, this used to take a lot of time, but it also used to create a lot of stress in my mind that I need to track, and before every spending, I'll put it down in that Excel. So that really didn't work for me. The approach that worked personally for me was I knew roughly what I need for my monthly expenses, right? So the rest of the money I used to just transfer to my investment account, right? So another approach, this is called pay yourself first. So as soon as the salary is hitting my account, I knew that, let's say I wanted to save, say 40% of my salary, so 40% just goes to the investment account. It's invested, and rest 60% I have to manage with that. Right. So that is one approach I followed that worked well for me. But it might not work for someone who is really spending a lot on their wants, going out, buying gadgets, and all of those things, right? So for them, definitely they need a much more tighter budget. They need to know where the money is going so that they can control it better. So it totally depends on your personal situation. For me, that approach didn't work. It created a lot of stress. So I followed that simple approach and it worked beautifully for me.
Awesome. So Satya Kumar is asking, he's stuck in a vicious job, a dead-end job, which is a story of a lot of people in our country, I think. And he's asking, how does he grow income from salary if that job is not good?
So yeah, uh, so I'll tell you quickly tell you my story, but before that, I also want to share one more thing. See, here this specific webinar is about how do you reach your that first crore, how do you reach that milestone fastest, right? Uh, but it's not, if you think about it, I think the question that comes should come to your mind is that the right really um, target you want to set for yourself? Is this the right thing that you are optimizing for yourself? Right. So here we are trying to optimize our portfolio. How do you reach a certain milestone the fastest? But in life, you have to decide for yourself. What is it that you want to optimize? Right. It could be that you want to optimize a very balanced lifestyle. So in that case, you might not want to go for the highest income job that you can get, but you might want to take a job that is not paying you the highest, but it gives you that flexibility, right? Or a job in which you learn the most, right? Or a job in which you enjoy the most. Personally, the story that I was talking about earlier, in my initial years when I started working, I got a pretty good job. It was with Oracle, but I didn't enjoy it. I lasted only 1 year. And the thing I realized is this is a job, although it's giving me very good salary, but this is something that and I'll be able to reach my first crore the fastest in this job. But that's not what I optimized for. I optimized for is something that I would enjoy doing, right? So then I left that job and started searching for the kind of jobs that I really would like to do, right? And that's how I landed in trading. And I really loved that thing, even though at that time I had to take 50% pay cut to join trading. And obviously, it was a big risk because I never traded earlier. I kind of thought I would do well, but obviously, Trading is a different ball game. I've never traded. I came from engineering background, so I never knew how I would do. But I thought I would enjoy that thing, and if there's something that you enjoy doing and you do it for a very, very long time, you'll be able to do you will be able to do it for a very long time, and obviously money would follow. And that's what happened. I did very well in trading, but initially I did not optimize really. That was not, frankly, the fastest way, because in trading 90% of the people actually are unable to trade. It's just maybe 5 to 10% who are able to uh, do good trading, right? So I think it's very important also to question what is it that you are targeting, and it's not necessary that you target and optimize for your first crore. If you are stuck in a dead end job, you might need to take a pay cut, but if you land up in a job which is you like, I think then you are really, really lucky, because as you said, Ankit, most of us are stuck in a dead end job which we really hate, right? So it's very important to keep looking for that job uh, that you really enjoy, even it is at the cost of. Frankly, I was lucky also enough because I did not have any financial obligations towards my family or any other financial obligations. If I had, maybe I wouldn't have taken that, able to take that kind of risk. So if you are in a situation, if you can take that risk maybe of taking a reduced income and going for something you love, go for it.
That's wonderfully answered. And you mentioned we are stuck in a dead end job. By we, I didn't mean me. I
Yeah,
love
yeah,
my
I
job.
get it. Yeah, yeah, I get that.
And yeah, so I think focusing on human capital is extremely important in the beginning of your career. So I think Satya Kumar should focus on increasing his human capital and change jobs.
Yeah.
Do you want to take more questions, Vivek, or do you want to continue with
If
the
there is,
slides?
up to you. If there are too many questions, if you have received few questions, I can take maybe one or two more and then proceed.
Sure. So Sunil is asking about कि हमें लोन पे पहले करना चाहिए या फिर हमें इन्वेस्टिंग पे फोकस करना चाहिए.
Okay, I think it's a pretty good question. And it totally depends on the kind of loan. तो आपको, अगर आप आई थिंक ऑनलाइन सर्च करेंगे तो आपको काफ़ी अच्छी एक्सेल फाइल भी मिल जाएगी, जिसमें आपको ये दिखाया गया होगा कि अगर आपका इन्वेस्टमेंट से रिटर्न एक्सपेक्टेड लेट्स से एक्स है और आपका लोन वाई है। ब्रॉडली स्पीकिंग, अगर आपका लोन क्रेडिट कार्ड है या कोई इस टाइप का लोन है जिसमें आपको, I think apart from home loan, I can't think of any other loan which is really you should not pay back faster. So if it is a loan which is not a home loan, then you should definitely try and pay back faster. But if it is home loan, I think even then the answer is not very straightforward, because काफी लोग ये बोलते हैं कि अगर होम लोन है तो इट्स अ गुड लोन, you are getting a lot of tax advantages also, and the return, the interest on it is lower than what you can achieve in your through a portfolio. So mathematically, that's the right advice, but that advice really does not really is not applicable for everyone. I think you should also think from your perspective, because I have spoken to many, many people who really don't like to have any loan at all. And for them, they'll be only able to sleep peacefully at night if they have paid back that loan. And for them, that is the right answer, really. That even though mathematically that's not the best answer, but for them, they'll be able to sleep peacefully at night if they are able to repay that home loan or whatever loan is at the fastest pace, is the right answer for them, right? But mathematically speaking, if it is home loan, I think it's good to have. You can take home loan and not pay it back faster, and whatever excess money you have, you do investments. Yeah, that's what my answer is. So it's totally, totally personal at the end of the day.
Makes sense. And for most of the people, I think the low interest amount that they are going to pay on loans is going to be very close to the returns that they're going to make on equity. And equity markets are uncertain. That return is might show up, might not show up, but you will have to pay the EMIs, you have to pay the loan back. And the harassment that some of the loan recovery agents does in case you're not able to pay, that mental torture is too much. So I think most of the people should approach a conservative approach and focus on paying the debt first. If it's not home loan or very long-term stable loan, then trying to invest.
Yeah.
Uh, we have another question from Himanshu is asking, how do we calculate a risk appetite, which provides us perfect segue to the current slide that we have, power of asset allocation, and we also have a risk calculator on our website.
Exactly.
So,
Yeah.
Vivek, over to you.
Yeah. So we on our website gullaq.com, that is GULAQ.com, there is a risk calculator out there. You just take that will take maybe 2 to 3 minutes of your time, but it will give you some indication of what's your risk appetite is, what's your risk profile is, and accordingly you can select roughly that, right? What I have seen really is a lot many people, when they take these kind of surveys, their risk appetite is, it tells you that your risk appetite is, let's say, medium. You should be investing, let's say, 60% in equity, 40% in debt. But when I see them investing, they are taking a much more higher risk, right? And that's what happens, that you are, if you're taking higher risk in your portfolios that you can actually take, afford to take, in that case, you are unable to really stick with it for long term. So what you should definitely do is go to gullaq.com. In the calculators section, there is this risk profile survey. Take it. It will give you a roughly good idea about your asset allocation.
Okay, Vivek, I think we can continue with these slides and take some more questions towards the end.
Yeah. Okay. You can see my screen.
Yeah, it's visible.
Okay. So we have spoken about asset allocation and how one should go about it. Take that specific survey that is going to tell you how much you can uh, invest in equity versus invest in debt. So these are the gears that we follow, a gear-based approach, even in Gulaq portfolios that are listed on small case. We have rolled out gear-based portfolios only. Gear 6 is 100% equity. If you are very aggressive investor, you can choose either gear 6 or gear 5. For moderate ones, select between gear 3 and 4. For a conservative one, I think still gear 2 to 3. If you are 100% in debt, I think you it is very hard, in fact impossible for you to beat inflation after paying your taxes and fees. So, uh, if you're moderate or conservative, gear 3 should be fine. So, this is an approach that we are following. Obviously, with higher allocation to equity comes better returns, but it comes at the cost of volatility. There's huge, these equity markets are hugely volatile. Every year, you could see 10, 15 to 20% of up and downs overall. So it's not for everyone. Definitely gear 6 or having 100% in equity is not for everyone. The perfect analogy here is what I have heard is uh, like equities are like accelerator. So obviously you want to go fast, so you need equities. Like you want to go fast in a car, you need that accelerator. But you can only go fast if you have brakes in your car. So if you have that, if you don't have brakes in your car, only accelerator, you won't be able to go very far, right? You're going to crash your car. So debt acts like brakes in your portfolio. So have some amount of debt definitely. It could be 20, 40, 60, depending on your risk profile. But definitely have a decent amount of debt as per your risk profile in your portfolios. Okay. One of the again very common questions is should your portfolios be professionally managed or should you do it on your own? So select stocks on your own and then manage your portfolio. I think lot many people, because there are obviously lot of influencers who want to teach you how to pick stocks in their courses. There are a lot of content out there which will actually tell you how to pick these specific stocks, right? And that's why we believe that if we pick stocks on our own, we'll be able to generate higher returns, we'll be able to have much better control of our portfolio, and hence reach that first crore milestone at a much faster way because we'll be able to generate higher returns. But if you really think about it, that's really, it seems like a faster approach, but it's going to be taking you much longer for most of the people because there's this report by S&P. They do this every I think two times in a year, where they actually study all the mutual funds that are available and their benchmarks. And what is found in these reports is that 93% of professional large cap fund managers fail to beat their benchmark over 5 years. For small and mid cap, this figure is slightly better at 77%. But this is also majority of the mid and small cap managers fail to beat their benchmark. So if these are professionals, they have large team of analysts with them, and if they are unable, most of them are unable to beat the benchmarks, what makes us think that we'll be able to do a better job than these fund managers? Right. So there's very, very small evidence that you'll be able to do small probabilities, very small chance that you'll be able to beat the benchmark index. So for most of us, it's very if you're just starting out, it's definitely best idea to stick with passive funds, index funds, and as you gain experience, you can decide on how much active fund you want. Active is the word we use for those managers or those funds that are trying to beat the index, right? And passive is those funds which just mimic or track the index, right? So with experience, you can try, but try to see how much of active versus passive you want in your portfolio. But picking stocks on your own, there's tons of studies out there, tons of research out there, which tells you in every one of them that the people who try to pick the stocks on their own, most of them tend to do worse off than even the index. Right. So, so this specific slide talks about your circle of competence. What's your primary profession or expertise? So, if you are a doctor, you're obviously not a full-time investor. If you're trying to do it on your sidelines, it's just some hobby for you. Maybe you are interested in it, you want higher returns, but that's not your area of expertise, right? So, if you're not a full-time investor, please do avoid direct stock picking. Avoid trying to time the market, avoid chasing hot tips, right? Because in a world of extreme specialization, staying outside your circle of competence is actually quite dangerous, right? So you have to, the simplest approach, as Ankit said in the beginning, it's quite a boring approach, but it's counterintuitive. That's what leads to the fastest first crore. That stick to systematic diversified portfolios. To begin with, in the index fund, you select index funds or ETFs, and two to three well chosen mutual funds is good enough. In our Gulaq app that we have just released, we are looking at that data that an average investor holds 19 mutual funds, so they are over diversified, right? So that specific approach of having just two to three passive funds work well in the beginning, and with time, as you gain experience, you can decide how much of active versus passive you want it to be. There are few investors who believe that they can pick the right mutual funds and they want to go 100% active, but it's not really either you are active or passive. There are many investors, For many investors, the answer depends on many things, and you could be somewhere in the middle, right? It depends on your conviction in active management, how much sensitive to fees you are, because in active management, fees is slightly higher. And even though you are picking mutual funds, there is some time commitment required for that and some past experience. So it totally depends on uh, your approach, your conviction in active management. Personally, I have mostly tilted towards active management. So my portfolio, I think, would be roughly about 60 to 70% maybe towards active, and rest 30 to 40 would be passive index funds. That's what I believe in. But again, this answer I think is very, very personal. For some, they prefer 100% active funds. For others, it's 100% passive. And for many others, they lie somewhere in the middle, right? Ankit, any questions on active versus passive, or some of the things that we have discussed in the past few slides?
Yeah, we have one question from Vinay. He's asking about smart beta funds, which are passive strategies. So he's asking if they are a good choice for consideration.
See, my answer might be biased because we in ST do follow these smart beta approach, or what is also known as quant investing or factor investing. That's what we are doing. The results are pretty good. It's been more than 5 years that we have live, and we have given huge alpha. I personally like that approach, but as I said, my answer might be biased because that's what we practice in ST. But there's certain things definitely here that I would like to highlight. First is, I think it brings the best of both worlds because it is a very, very systematic approach. It does not give your manager complete freedom in picking stocks, right? Because if you give that manager complete freedom, there's obviously lot many biases also that fund managers have. A lot of preconceived notions or biases which come in the way of making the right investment decisions. So this is somewhere in the middle in the sense that it gives you good amount of freedom to the one fund manager, but under some constraints, under a systematic approach. So that is one thing. Second thing is about fees. I think broadly, if you look at mutual funds, the fees in these smart beta funds are going to be somewhere in the middle. It's going to be slightly higher than the passive funds, but it should be lower than the actively managed funds, right? And this being quant, and because my background is also engineering, I come from that data analysis approach. I think there's huge advantage in this day to not follow a data driven approach. I think in most of in the jobs, be it marketing, be it you're a doctor or any other job, I think everyone is looking towards data to do their jobs better, and that's what this approach leads to. This approach is totally dependent on making data driven decisions. So till the time not many people are practicing this in India, I think the smart beta funds are going to do well. Maybe 5, 10 years down the line, you have too much of competition, and then even they would struggle. A few of them would still do very well, but most of them would struggle. But as of now, I think because not many fund managers are practicing this approach, I feel it's relatively easier, if I can say that, to generate alpha. That's what my understanding is.
Wonderful. I should have been a little more specific with the question. The user actually wanted to know, are there a good passive option? So Nifty has a lot of smart beta options, right? Low volatility momentum. And if we
Yeah,
look at performance, it's amazing, like
yeah,
20%, 30%. But those are not live performance, those are simulated performance, and they show
yeah.
extremely high tracking error, and there are whole range of risk associated with those options. So when you are talking about active versus passive, can people take those smart beta funds as a passive
I think,
options?
yes, I think we can take those options. You can consider those options. Only thing is, uh, there's no free lunch in investing, right? So, why I'm saying that is, it comes, I think many of these funds come with higher risk, like these alpha funds or funds which are based on momentum. Many of these are able to produce higher returns because they are taking higher risk. It's not that that's a free lunch and with the same amount of risk they are able to generate higher. I say many, not all. There might be few funds which are where your risk does not go as much as your returns goes up, right? But for many of them, that's the case, that they are taking on higher risk, which would reflect in their drawdowns, in their volatility. So when the markets are going down, obviously, when the markets are going up, they'll do very well. But when the markets are going down, many of these funds might give you higher drawdowns than the normal index funds that are out there. So I think you can definitely consider, but do keep these things also in mind when you're trying to select, that it's not, this excess returns is not free. You are taking on more risk, which means your portfolios are going to be more volatile if you select them. And if you are okay with that, then maybe you can select. So look at those ratios, look at Sharpe ratio. Sharpe ratio is actually going to tell you whether you are whether this specific fund is taking higher risk adjusted returns, is delivering higher risk adjusted returns or not. So that is one good ratio you can track.
Wonderful. I think we can go back to the slides again, and towards the end, we can address the remaining questions.
Right. Okay. So we already spoken about active versus passive. So the default recommendation here is somebody who is starting out, start with index funds, gain experience, gain confidence, and then you can decide how much of active versus passive you want in your portfolio. Right? So finally, here in this section, I'd like to discuss the mistakes that you should be avoiding in order to reach your first crore in the fastest way possible. As I told you, I have made all of these mistakes. I still do make some of these mistakes, but I try and avoid these because I have some experience, right? So I'm going to discuss this. So the first, sorry. So this is the first mistake, having an emergency fund. So if you have just invested in equities, that's definitely not a consumption hedge. If you need some money urgently and say the market is down, then what you will be doing is you'll be forced to sell at the worst time when the market is down really, right? So first thing that you should do is start an emergency fund also. Now, some of the people say that you should just invest in emergency fund, and when you have done with it, only then start investing in the other fund. I personally feel that you can take a balanced approach. Definitely don't put money aggressively in investing until you have a decent emergency fund, but you can start in the beginning, maybe put 60 to 70% in emergency fund of whatever you're saving and 30% in your investments. But definitely focus much more on this emergency fund. Like the breaks example I gave you, this is similar to that in case you need it, it's going to come in handy and it's going to help you a lot, that you don't have to take you take that risk off the table, that equity markets are down and at that's the time you are forced to sell, right? So it will help you in avoiding that specific selling investments during crashes. It will avoid you taking on high interest personal loans, or breaking your FDs prematurely, or maybe even asking family for help. So this is definitely required. How much you need? I think in the initial few years, having couple of months, maybe about 6 months, is a good emergency fund to have. Obviously, when you have gained your experience and you have much higher financial obligations towards your family, that's the time you should have a higher emergency fund. It could be somewhere between, say, about 2 years or so, also, right? In this day and age, when we see a lot of job losses, and if you are in such a profession where you have those kind of risks, definitely it's going to help you a lot if you have about, say, 18 months to 2 year kind of emergency fund. But that's later if you're just starting out. I think about 6 years, 6 months of emergency expenses should be fine, right? Second is having insurance, right? Health insurance, about 10 lakhs of cover for yourself and family, with top ups, super top ups for higher coverage. And obviously, I think all of you would know that with age and with family expansion, your cover should keep on increasing, right? Your term insurance also, if somebody is dependent on you for your income, take that cover. Ballpark number of 10 to 15 years of annual income is fine, but you can as well use that specific Excel that we'll be sharing with you of human capital to give you some sense of what kind of cover you need, right? And also buying when you are young really helps you because at that time the premiums are cheaper, whereas later in the later part of your life the premiums becomes really high, right? What to avoid in this? There's many insurance products, and personally, I have also, as I told you, invested in these, which club investment and insurance. And what happens in these is these are usually known as endowment plans or ULIPs. What happens in these is the fees is very high, and a big part of the fees goes to the insurance agent actually who has sold you those kind of policies. So the actual returns, even though they might package it in a way it looks very exciting, but if you really calculate, let's say the XIRR of that specific investment, it comes out to be at FD or mostly lower than FDs also, right? So 99% of these products are really, you should just avoid at all. Insurance from LIC agents pushing commission heavy products, and these are essentially ULIPs and endowment plans are essentially these commission heavy products that we are talking about. And skipping your insurance, either health insurance or term insurance, because you are healthy. That is one mistake you should definitely avoid, right? Next one is, sorry, oops. Okay. Next one is trying to time the market. Uh, this is, I think, pretty common. This is something we all would, we all love to do. But there's this very famous quote from Peter Lynch, who was the famous fund manager managing the Magellan Fund. He has also written a couple of very good books for you to read. So the quote goes like this, that far more money has been lost by investors trying to anticipate corrections than has been lost in corrections themselves. So I know many people who have been trying to anticipate corrections for last couple of years. Obviously, this year they were correct, but prior to that, for a couple of years, they have been just missing that opportunity. What the equities gave very high returns prior to this specific year. So this year, obviously, they're feeling very good, but overall, for the past couple of years or for the long term, you actually end up losing a lot more if you're just trying to anticipate and avoid these corrections, right? So equities have delivered huge returns, have they delivered these huge returns in spite of those corrections of 40-50%, which could happen once a decade, right? So do try and avoid this thing, and especially you see if you are watching a lot of news channels, which lot of these investing news channels or economic news channels, business news channels, they actually, if you're watching them, then you get really motivated to take those kind of calls because it looks very easy. Maybe once in a while you are able to do it, but over long run, it's very hard thing to do even for professional fund managers, right? So just try and avoid, keep things simple, focus on your job, on your career in the initial parts of the year of your career, and leave market timing and all of these things, leave it aside, right? Another one is if you watch those business channels, they talk about stocks, they talk about themes, they talk about sectors a lot, right? Again, these are the things that rarely work, right? So again, avoid trying to time. these kind of entries and exits into those sectors. Once in a while, it might be so tempting that one sector has given huge returns last year, it's expected to do well. Maybe you might make some money, but that's not a sustainable way of investing over long run. What would happen is 1 or 2 years you get very good returns, then 1 or 2 years when they correct also these sectors, these hot sectors, they can easily take away 50% of your portfolio. That's the kind of correction you very frequently see in these hot themes or hot sectors. So it's not for you to manage. Invest in a diversified fund and you leave these decisions to your fund manager as to which specific theme or which specific sector he should be investing in. That's what you are paying him for, right? So you're paying him that fees to manage the money on your behalf. So why do you want to take these kind of calls? You should never be taking these kind of calls. And finally, the mistake to avoid is you exit very early. Again, if you're watching business news channels or reading too much into it, definitely your funds, whichever you have invested, if you have invested in active mutual fund or even passive mutual funds, the average holding period of Indian mutual fund investor is currently last year was 2.2 years, whereas 10 years ago this was 3.3. So it has actually come down in spite of all the education that is going around through these business channels or influencers. It has come down, and I feel it has come down because of the noise. These social media channels have made it very, very easy um, for this noise actually to consume this noise. And if you're consuming this noise, it's very hard for you to hold these specific mutual funds for long term, right? And the years, the kind of years that we are talking about, your first crore actually requires at least about 10 years or so, depending on how much you're investing. But that's the kind of time frame you're looking at. If you can't really hold your investments for that long, it's going to be very, very hard for you to reach your first crore in a reasonably good amount of time, right? So yeah, I think that brings us to the end of our PPT. I'll stop here now, and Ankit, let's take questions that our attendees might have.
Thank you, Vivek. That was a wonderful session. Quite heavy, a little boring, but very good advice, I think, for people. Very useful advice. We have quite a lot of questions. We had also prepared that template for the road to 1 crore. Do you want to show that right now, or should we
Yeah,
address
yeah,
some
sure. I,
questions
I
first?
actually forgot to share that. Just give me a moment. Yeah. So this is a very nice template. It will, whatever data also we have shared in our PPT, it is using this specific template only. So again, towards the end, we'll share the links to this specific Excel. Ankit, can you see the screen?
Yes, we can.
Yeah. Okay. So the inputs here are, it's pretty simple to use. You can go and look at the README also, but I'll quickly explain you. Whatever you are saving monthly investments, you put it here. Say you're saving 50,000 expected annual returns. This you should get from ideally uh, about your, it's dependent on your asset allocation. So if you are investing primarily in equities, you can you can expect about 12% or so. But if you're investing majorly into debt and little bit in equities, then this return could be as low as, let's say, 8 or 9% also, right? So this 12% is dependent on your asset allocation. And what's the annual step up? So how much annual step up in your monthly investment? So what is it that you'll be able to do, whether it's 5, 6%, 10%, or even 20%, right? So you put in these numbers, and based on these calculations, this specific area is going to show you how fast you're going to reach your first, second, third, and fourth and fifth crores. So here, for this specific example that we have taken, it takes about little less than 8 years to reach your first crore. But in less than 16 years, you will be able to reach 5 crores. So in the first 8 years, you manage to do one, and in the next 8 years, you'll be able to do 4 crores. So it's a nice Excel. You can use it and get to know exactly how long it's going to take. Be very careful about this specific one, the expected returns, because if expected returns are higher, then obviously it's going to change a lot. But at the same time, see, be quite conservative about expectations, because I have seen most of the people who make mistakes, who run after those hot themes, hot sectors, or who try to time the market, who try to pick multi-bagger stocks. I think the common thing amongst them is they expect much higher returns from equity markets. I think having about 12 to 14% return is reasonable. When you start expecting much higher returns from equity markets, that's where you tend to start making those mistakes that we spoke about in the end. So yeah.
Wonderful. I'm just going to start addressing the questions we have in the live Q&A. So, in case you want to ask some questions, please start dropping them now. So, we have a couple of questions around Gulaq's mutual fund and SIF. So, if you would like to speak on that.
Yeah, so mutual funds definitely I think as we have earlier also in couple of webinars we have informed, ST has applied for mutual fund license. We are expecting to get the approval pretty soon, maybe in next couple of weeks. But the launch obviously takes a much longer. So in next couple of quarters, we would be launching mutual funds, ST's mutual funds. That's what we'll be doing. SIF, obviously, we got to think about it, but ST definitely has the kind of capability that is required to manage and launch SIFs, because we have been doing a lot of strategies in futures and options. And this SIFs allow mutual funds to launch funds using these futures and option strategies. So that is another thing that we would be doing, but again, it's going to take couple of quarters. A couple of, I think people are also interested in, I think I saw a couple of questions related to SIF, whether they can invest or not. My personal view is I'm not too bullish on SIFs at this stage because they don't have any track record, right? And the ticket size is also higher. Now, I believe that most of the investors attending this webinar don't have that kind of money. They haven't reached that first crore. So investing 10 lakhs is kind of huge in one fund, and especially those kind of funds which haven't delivered anything as of now. So I would advise everyone to wait for a year or so, look at these SIFs, because currently I think only two or three SIFs are available, but have at least wait a year or so, let them prove themselves, and only then evaluate whether you want to have them in your portfolio or not. Otherwise, yeah, that's what my view is.
Just to avoid the confusion, Vivek is speaking about SIF, SIF, not SIP.
See.
So you should definitely continue SIP. SIF is Specialized Investment Fund, which was recently launched by uh, SEBI, which allows users to invest a minimum of 10 lakh in creative strategies like long short or arbitrage fund, which are traditionally not allowed for public mutual funds. We have another question for you, Vivek. Actually, it hits home for a lot of people, I think. It's a question which is asking about discipline. So, all these planning seems fine, but once we start
Yeah.
executing it, we're not able to follow the plan. So, how do we stick to the plan, what we are preparing?
Yeah, I think as someone, I think Warren Buffett or Charlie Munger, someone said that investing is pretty easy. The rules are pretty easy. What is tough is actually following those rules. So it's pretty easy and simple to understand what needs to be done. But obviously, it's very hard because it takes almost a decade to reach your first crore. And to not lose that patience, to not get distracted by all the noise out there in the market, um, is very, very hard, frankly. Yeah. Couple of things that I have done in the first 10 years, because in the first 10 years I was trading also, and discipline is definitely very much required in trading also. right? Couple of things that helped me was reading about history, financial history, reading about how markets have behaved, what happened in 2008 crisis, what happened in 2000 or even earlier. There are hundreds of years of financial history which is available in books. So it gives you a very good perspective of what happens in markets, the booms and bust, and what causes those booms and bust. And it has been going on for past few centuries, and it will definitely go on for the past next few centuries. That human behavior is not going to change. So learn about that human behavior, learn about financial history. That is one thing that helped. Uh, Another thing that helped was there was not too much of social media at that point of time. I started trading in 2005. So these social media apps were not there. Obviously, there were business channels. So tried to stay away from those business channels. So at this age, definitely try and stay away from uh, influencers out there. There are many influencers. There are few good ones also. Uh, so select the people who you follow, whom you take advice from. If they have experience in markets, I think that is one way definitely you should select, because many of them don't have too much of experience. They have maybe 2, 3, 4 years of experience, which is very little, close to zero, right? So follow people, follow those mentors who have some decent, at least a decade of experience, if not more. Follow those people and try and avoid noise. Another thing that helped personally me was meditation and journaling, because in trading you are making a lot of decisions on a daily basis, but I think that that's going to help even in investing, although you are not making those decisions on daily basis, but in some sense you are also making those decisions on daily basis, because when you are tracking those news, the decision every day is whether to stick with the fund that you invested or look for new ones, right? So I think meditation really helped me in trying to keep my discipline, stay disciplined, and do what I wanted to do, follow the plan, and journaling. So these are some of the things that helped me. Yeah.
Do you have any book recommendations for us on how to build this discipline and resilience?
Not one book, I have read many. Uh, Pulled by Randomness was one that I really liked, right? Beating the Street by Peter Lynch. One is by Howard Marks, which is the most important thing. Yeah, these are some of the books that I really liked that come to my mind.
And Sandeep Tyagi has also written this wonderful book, The Little Book of Big Gains.
Yeah,
Sandeep is the CEO and founder of ST Advisors, which is the basically the parent company of Gulaq. So that is also a very good book. You should read it
yeah.
definitely.
And many of these concepts that we spoke about in the last 1 hour or so, I think many of these concepts are very well explained and talked about in that specific book, the Little Book of Investing. So that one is, yeah.
All right. So Sanjeev is asking, he's a retired man now and he has a PPF of 50 lakhs. How should he invest this right now?
So I think it's very hard for me to tell this, because for that I would definitely need to know what are the other areas where you have investments in, whether it is, say, real estate or uh, other which all areas that you have invested in. So yeah, Ankit, can you hear me? Yeah, okay. There's some issue. So it's very hard for me to tell. I think what I would advise is, really, we do this webinar and we did it couple of weeks back, that 4% retirement rule. I think that is one thing that would really recommend him to attend next time. We'll be definitely doing it in next couple of weeks. Because in that we talk about how much of portfolio one should have, what is the money that you can use every year. You can redeem, take out from your portfolio for your expenses, which is about 3 to 4%. We spoke about that a lot. And also where to invest that money, because intuitively you might be able to decide that if equities are giving you the highest returns, if you invest most of it in equity, that's the best way to go about it. But that's not really right for retirement, because in retirement you are taking out money. So let's say one example, that when you are taking out money initially and the markets have corrected by 20-30%, and that's the time you take out money. So essentially what is happening is you are booking losses. You lost money while going down, you were invested fully, but now when you've taken out money and market starts to recover, the recovery is not happening with full amount, it's happening with a much smaller amount, right? So that's the biggest risk in retirement, and that's why you should not have 70, 80, 90% in equities. You should have maybe somewhere between 40 to 60%. That's the good number to have invested in equity, and rest in safer instruments like fixed income mutual funds. So that's about asset allocation, about how much you can take out. The very aggressive number is 4%. In Indian context, as we have spoken earlier in our webinars, it's about maybe 3.5% is what you can withdraw in the first year. And post that, you adjust it by inflation. That's a very good approach that can last you very long. Yeah, those are some of the initial thoughts. But yeah, we do that webinar every couple of weeks. Try and attend that. I think we go in depth in all of these things that I've just spoken about related to retirement planning.
Just a follow-up question. Sanjeev is asking, in what ratio should it be, in equity, balanced, or liquid? So is there a fixed ratio, or does it
So I
totally
think
depend on one
broadly,
person?
depending on your risk profile, you can have anywhere between even 30 to 60% in equity. Now, how you invest is you could be slightly more flexible, in the sense that if you do it through hybrid funds, you are leaving that decision to the fund manager of equity versus debt, or you can do it on your own, right? So it depends on your knowledge and interests. You could either do it on your own, select the funds of equity and debt, or you could even do through hybrid funds where you're leaving the decision to the fund manager, which is a fairly good approach if you do that, right?
Okay. So another user is asking, he has over 1 crore in investment and 99% of that is allocated towards equity. So he's asking, how does he rebalance this 1 crore corpus into other asset classes so that that market fluctuation is smoothened out?
Yeah. So I think create a plan. First of all, take that risk survey on Gulaq.com. Figure out how much of equity, how much of debt you should have. Let's say you decided on 60% equity and 40% debt, right? There are a couple of things that you can do. Every year, now we are sitting in October, in next couple of months, you will get an opportunity to do tax harvesting, right? So every year you can book up to 1.25 lakh of profits, and you don't need to pay taxes on that. So do that tax harvesting, use that every year, book that 1.25 lakhs. In fact, on Gulaq app that we have launched, you can use it. We do have a tax harvesting feature which can help you determine which specific funds you can sell to harvest those taxes. So you don't need to pay uh, long-term capital gains tax on that, and that money you can redeploy in debt. Secondly, whatever new money that you are putting in, that you should definitely invest in debt so as to make this asset allocation right. And thirdly, it totally depends on how fast you want to reach. Let's say you want from 99 1, you want to reach to 60 40. How fast you want to reach. So look at these two things, how much SIP you are doing. And if you want to reach that stage at a faster pace, then it's okay in booking some part of the profits, but you can make a plan. Let's say over next 6 months you want to reach that. So over next 6 months you want to maybe exit a bit from equity and transfer towards debt. But these are essentially the three things that you can do in order to rebalance from where you are to where you want to reach in your asset allocations. The tax harvesting part, uh, the SIP, that the new money you are putting in, and actually selling equity and moving to debt.
Okay. So another question is, what are your views on international market? Should we invest in international funds?
I think initially, because here we are talking about investors who are in the initial uh, years of their investing journey, I don't think that's a very big decision to make. You invest in funds that you like, mutual funds, and you stick with it. Because as we spoken about, your income is much more important than the returns or even asset allocation, right? तो asset allocation थोड़ा बहुत ऊपर नीचे हो जाएगा, इंटरनेशनल है या नहीं है, that's not a very big decision. I think overall longer run, I personally like to have some part definitely in international funds, but it depends on your goals also. So let's say if you have kids and you are planning their education abroad, in that case your expenses, those expenses are going to be in USD terms. So in that case, you might want to have a higher allocation to international funds. That is one thing. Second is definitely for diversification, it helps. Uh, what has happened is last 10 years, if you see last 10 years versus the previous 10 years, and if you see US equity versus Indian equity, the results have been quite different, right? In one decade, US equities outperformed, whereas in another decade, Indian equities outperformed. So it's definitely very good to have some decent allocation to international equities. Uh, for diversification, right? But as I said, if you are very early on, don't worry about these things too much.
You mentioned about tax harvesting. Pulkit is just asking a follow-up question on that. So the maximum you can save around with the tax harvesting is around 15,000 per annum. And he's asking about slippage. So should we be worry about slippage since you have to sell your investments, book that gain of 1.25 lakh rupees, and then reinvest it?
Yes.
So you might be seeing some bit of slippage. So he's worrying that if the slippage is more than 1%, which seems quite high, then all that tax advantage that you're getting from tax harvesting might erode. So what are
Yeah.
your views on that?
I think that is more dependent on luck, really, right? So it's dependent on luck, really. That's not in your control. But if you just see that overall, if you are in a 60-40 portfolio, let's say, right? So your expected returns are about 10% for the year, right? So less than 1% for the month. So for the day, the volatility should be much lower, right? So that's what the expectation should be. But obviously it depends a lot on luck. 2 दिन के गैप में इट कुड बी कि मार्केट्स 1% ऊपर भी चली गई है या 1% नीचे भी आ गई है. So I think over long run, if you keep doing that, luck element will be eliminated. So you keep doing this for 10 years. किसी साल आप लकी होगे, किसी साल आप अनलकी भी होगे. तो ओवर लॉन्गर रन, आई थिंक द सिस्टमेटिक अप्रोच इज, जो भी एक्सपेक्टेड वैल्यू होगी वहीं पे आ जाएगा. कुछ साल आपको अच्छा लगेगा, आपने रिबैलेंसिंग की एंड यू मार्केट फेल डाउन. बट कुछ साल वो दूसरी साइड भी होगा कि मार्केट ऊपर चली गई और आपको हायर प्राइसेस मिल रहे हैं. बट ओवर लॉन्ग रन आई थिंक इट्स नॉट रियली a big decision. It's not in your control and it's going to even out in longer run.
Do you recommend looking at VIX, the volatility index, and doing the rebalance when the VIX is more calm?
That's a good idea. But see, many times what happens is most of the investors do this tax harvesting in February or March, right? So that's a very small window you have if you are dependent on towards the end, and then you are just dependent on the market. Whatever VIX is, it is, right? But if you are able to plan it out well, then I think, yeah, that's a good idea that VIX, if you follow VIX index, and whenever VIX is lower, you do that. So it'll not have those kind of large movements that we are talking about. But Ankit, there might be many investors in this who don't know about VIX. So do you mind explaining what is this VIX index, what it signifies?
So VIX is just a volatility index. So it's an aggregate index. You cannot invest in this index. It's just a sentimental score. So if VIX is very high, it means that markets are perceiving very high amount of volatility. There is high amount of fear in the market. As compared to when VIX is more calm, it means that investors are perceiving less risk, less volatile. It's a very simple
And you
measure.
can just, yeah, you can just Google it, India VIX or VIX India. It's going to show you that specific VIX chart. Uh, Currently, I think it's towards the lowest only, around 10. Uh, Highest, obviously, it can go very, very high, but it normally ranges between 10 to, I think, 15 or so, 15, 18. That's on the higher side slightly. But that is one thing, yeah, if you do track, maybe you can use that.
Okay, so we're losing a lot of people very rapidly. We are down to last 30 people. So we'll just take two more questions we have left.
Sure.
Vaibhav is asking buying versus renting decision. Should we, early on, should we consider buying or should we just rent it out?
I think early on, renting is definitely, in my mind, that's the solution you should go ahead with. Early on, you're not clear about many things. Again, I was just speaking to one of our teammates here at ST. Uh, he is currently in Pune, and he bought a house. It didn't turn out very well. That investing decision was a decent decision, but now he is moving cities. Right. And he is now definitely thinking about he won't be able to use it. If he rents it, it's not very easy because he's moving cities. He's not very comfortable. He wants to sell it. Again, there is some transaction cost involved, and now where to invest, all of those decisions. So I think in the initial few years, uh, over long run also, if you see, real estate gives you maybe inflation adjusted returns only, about returns of inflation. Equities is the best asset class to invest in over long run. That is one thing. Second thing is, you're not very clear. If you're very clear about one city that you're going to stay in, maybe you can consider. But many of us are, in the initial at least 10 years or so, we are not very clear about. We are happy in moving cities if we get better opportunities. But if you buy a house, you get into it. So I think in the initial few years, I would recommend not to go ahead with that specific decision of buying a house. Give it some time, and meanwhile, you stick with investing in mutual funds.
That makes perfect sense. Last question we have from Farhan. He's asking about PMS. So are PMS a good option over mutual funds?
See, Farhan, because PMS starts with 50 lakhs, and if you have about 50 lakhs or so, it's not a very good decision because you have that concentration risk of putting in majority of your savings in one fund. So what one should do is, I think we recommend that maybe have 3 to 5 funds. That is a decent number of funds. So which means have maybe about 30% to 15% of your overall portfolio in one fund. So if that is what you want to follow, in that case, mutual fund, PMS, one should only start thinking about when they reach a portfolio size of about 2 crores or so. that's the stage where when you want to start thinking about PMS if you want to invest. But before that, you should just stick with mutual funds.
Okay, with that, we are at the end of this session. Thank you, everybody, for joining. Again, this webinar is going to be streamed live on YouTube, so you can always revisit any sections that you missed on the YouTube channel of Gulaq. And we are going to be sharing with you the presentation as well as both the templates that you saw during the session. Thank you so much, Vivek. That was a wonderful session.
Thank you, Ankit, and thank you everyone for attending this. Thank you.
Okay, bye bye.